It'd be better if you could actually hear me. I just pulled a Yellen. Okay, let me start again. Happy Tuesday. Welcome to Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm joined by Jonathan Gibbons of VigTech.io. Hopefully you can hear me now. That was a pun, by the way. I don't know if anyone caught that earlier, but Yellen kept talking and forgot to turn her mic on. Can you hear me, Jonathan?
I can hear you.
All right. I joked because I said, sometimes I see your dad in here. There's a Fred Gibbons. Sometimes I hit it. How are you? Happy Tuesday.
I'm doing all right. How about yourself?
You got nice digs. Last time you were on top of the world.
Now I'm showing you my fifth home. This is my fifth home. This is just a nice background. I swap it up every week. It's boring on all these Zoom calls all the time. I'm tired of them.
But hey, thank you. We have this running gig. And for anyone new, let me just share with you every Tuesday, Macro to Micro Power Hour, and Jonathan joins me so we can talk about what's really important at moving markets right now. I also do one on Thursday, and every other Thursday I have a Women in Trading and Finance series as well. I am going to unshare this. Oh, and for housekeeping, it'll go on my LaDuc Trading YouTube channel under Macro to Micro Power Hour. We did a talk last week on bonds, and we're going to continue that as they're starting to bounce a little bit with oil. But basically, this is also kind of the day we're having, right? These are my risk indicators that started triggering, and this is an intraday risk range alert, and they're definitely triggering bearish today. So we'll see what happens in this lovely, what I call fragility of chop environment. But yeah, I'm tired of the chop. When does it end?
Well, just for clarification, I don't mind this webcast we do, every week. I do, get tired of all the Zoom meetings that I'm having all the time.
I don't know if you can share anything with us, but you have obviously alluded to a really exciting option project that you're working on that'll be client facing soon, in addition to all the VigTech.io user interface, launch and all the work that you've been doing in support of my risk indicator launch. So yeah, you've been on the phone a lot.
Yeah, we've been sourcing, kind of, I would call it like massive data and, high frequency speed type stuff and all kinds of different things taking place. It's like there's some shifting things changing in the data world from the exchange side. So a lot of cool stuff happening behind the scenes with all that. So we've been working pretty steady on that. We'll get something together for everybody, to try out the new options product in the next week to a week and a half. I think, based on the time frame that we're looking at right now. I want to try and get out there as soon as possible because this kind of stuff is going to be really, really useful. Because it's like it's not like smart money, smart tracking like people do, what have you. There's nothing wrong with that. But that, the options market overtaking the securities market means that it's more than just smart money, right? Like this is now, kind of, if you're a retail trader, if you're an investor, if you're an institutional trader, if you're a PM, if you're a RIA, you got to know where the options market's at as a whole, as an aggregate, and what this looks like, visually, topographically, the impact it's going to have, and you need to know it now, not 15 minutes from now or 30 minutes from now or yesterday. So we put something together that's we think is pretty important, pretty useful for everybody. So we'll roll that out, let everybody mess with it, and we'll take it from there. So I'm really excited about that. But that's why I've been a little bit busy the last few weeks. Been a MIA from my usual banter on Twitter and so forth. So
that's okay. You're doing God's work right now. Seriously.
That's right. That's what you call it. Yeah, that's what you call it. Hey, and you know what? You were talking about like some feedback on the indicators. I'm sitting there, and I got them triggering on my phone, my watch, and so forth, because I don't have a lot of time right now. I'm in and out of meetings and so forth. And I saw the one, I threw it out there on Twitter right before we got on the call, where IWM hit at 11:30, and you dropped in, and then we had some option stuff trigger at the same time, and that was a 3-point drawdown. It was huge huge drawdown that you could have, monetized. People could be monetized.
It was more than I actually thought it was. But just for my technical analysis, I gave clients of 218 level today for the IWM, and it blew right through that. So and this is the fragility of chop that we've been talking about, right? This is fast moving. I mean, even the oil pullback, and we talked about that last week, serving as a hedge, but it's gone so far so fast, 7 weeks straight. And then when it pulls back, it's vicious, and it's still in pullback mode. But doesn't mean it's not going to bounce by end of month. But right now, every hedge that we've come to hope would serve as, a nice long to this chop environment has greatly disappointed. So we'll talk about market structure and such right now, but it's kind of interesting how it's just very fast. I'm personally just tired. I want the snow to go away. I'm still in Boston. I can still see, north of Boston, I can still see snow on the ground, and I just want like the quarter to end. And get a little bit, go get some exercise outside and not worry about the market. But can't do that. GameStop has earnings, and I hate to say it, but I'm really curious. So, we talked about this months ago, and it was a fabulous, meme stock and such, and they're still playing with it. But today there's an expected move of 36%. And I cannot help but wonder if the Reddit gang has any idea the definition of IV crush. Expected move and all of that. And, it's moved 1,300% since its last earnings report. So cannot wait for that kind of.
Well, you saw, I think, who was it? Who was the latest executive that bailed out yesterday?
Oh, there are 2. Yeah, the CFO bailed out, and then they appointed a new CT, a chief technology officer that didn't even exist. But chief consumer officer and the CFO, they both left. But I mean, what can they say today, really, in an earnings call that will justify this rapid ascent? I'm just,
Well, there's not. I mean, you saw what happened yesterday. They said they're going to do $3 trillion in infrastructure on top of the 1.9 they just did, and and you're sitting there and you're like, okay, so we're talking about earnings, right? When there's throwing around trillions, it's like people are going to be. I was a millionaire. Oh, well, I'm a billionaire, right? It's ridiculous. So I mean, some of these metrics are so distorted. That's why we talk about it a little bit in the conversation here. When you think about it, and it parlays all the way down to GameStop and the rest of this stuff. This has been fun, right? But some of this stuff has it's set up for get lit up. You've seen a lot of the Momo stuff. It hadn't come back. I've been tracking that basket, and it has not come back. And does it give it one more run? I don't know, but I think that these things are definitely starting to kind of come to the conclusion here, where rubber's meeting the road, and GameStop is one of them. I mean, these executives checking out, I mean, if stock's going to keep going up and I'm got options and all this other stuff, I'm not leaving. Right, I'm gonna exercise these things, right? And so these guys are leaving, and it's like I watched have you seen the Netflix thing about Blockbuster, the last Blockbuster?
No, I haven't. I heard about it though.
Right, so it's that's GameStop. It's last GameStop in the world, but we're trading it at several $100s, right? So
I'm ready for it. I honestly just want to push it over the cliff. Just give it a good kill.
It is not a stock. It is a poker chip between players, right? It's just cards now, right? Because you got one set of hands playing the other set of hands. And,
that's a good way of putting it.
that's not a stock. That's just simply a mechanism between two parties going after each other. So. Okay. And I mean, once they're done or it's done, then the stock's trash, right?
I'm just, like I said, I just want to move on from it. It just feels exhausting.
Oh, it's tired. Yeah, it's
tired. So, but speaking of this, the call extravaganza, we got to go over a few charts that I have posted on Twitter of late. We do that, right? So we got a theme. And the theme, of course, is what the heck is the Fed going to do? But let's back up and see what the market is doing first as a result to what happened last week with the Fed announcement. And I can't help but go over some of these data points. Invesco, the Qs, tracks the NASDAQ 100, took in 4.9 billion on Monday, its largest one-day inflow since the dot-com boom in 2000. And in the article I grabbed, the key lead, a surge in options trading fueled the biggest inflow in 2 decades. So this is option flow, right? This is one indicator of the flow that's coming in. I love, this is just fragility of chop, but then the other look, which is from Spot Gamma, if I can find that, let me just find it real quick. We're going to go over that.
I saw that. Yeah, I saw that you posted that. It was good that he put together.
I'm looking for it. So one, of course, oh yes, this is it. So Spot Gamma did a write-up, and I grabbed the key points, right? Plus this chart, which is, okay, S&P has no short interest as it relates to any meaningful short interest. It's at the lows again, 2000. We keep hearing that over and over and over again. And Goldman points out the SPX short interest not only at the lows seen since 2000, but Spot Gamma has their own set of charts calling for, calling out that lack of hedging, so they're not really buying puts, and extreme call positioning invites a great deal of future volatility, especially if traders suddenly elect to purchase put options positions. They really haven't yet. So from what I can see, they're definitely not in this elevated put buying or protection. Today was fast moving with small caps as yields are, calming down after a 7-week advance. And it was interesting. I also had retweeted a stat, which was of the 9 periods where the 10-year has advanced 7 straight weeks. There are 9 periods. 8 out of the 9 times, it resulted in 7 weeks of downdraft, of softness of lower equities. And it kind of feels like we're just in that chop zone. So oil, the leg gets taken out. Bonds are now getting a bid into end of month, but it is also a very massive, peak to trough decline in long bond volatility. Long bond, it's time for this to kind of have a pop. Plus, we've got end of quarter rebalancing, pension rebalancing. So why not have this, do a little bit of move higher? But this is the chart that I think everyone is really expecting or hoping, which is this fractal, which is NASDAQ back in 1998 to 2001. Okay, and this I grabbed from Market Ear. They basically put a fractal of where we are right now. Okay, and you can see the inflows coming into the Qs. Everyone's expecting a blow up top, 4,600, in the SPY, whatever. This is the expectation with what you see in the call buying. We're very different from 2000 on a lot of metrics, but I can't help but kind of show this chart because I think this is sentiment, right? Of we're gonna have this advance. So even if you're already at a loss, holding these, tech plays that were down 30-40% not too long ago and really have not recovered, they've just chopped sideways for weeks, right? This is what folks are really holding their breath for. I don't know if that's a healthy attitude, but I personally would also like to just get that over with.
Yeah, I saw like 5 of those yesterday. Like, I don't even the 37,000 Dow. I had a 17,000 NASDAQ, is that right?
Yeah,
I think I
yeah.
saw, and then like 4,600, 4,400. The reality is that the NASDAQ from a market structure perspective, if the Qs go take out the recent top and then retest it and extend, no, by all means, just market structure, that's going to go. Same thing with the SPY, same thing with the Dow. I've been looking for the weakness in Dow for some time, just any kind of weakness in Dow. To give us some kind of inclination if there's any type of selling. And we got a little bit today. It was like a 1% drop in the Dow. And realistically, it was like almost 2% from top to bottom. So, I don't see any volatility though at the moment. Besides, just kind of the move today, there's just no volatility. And you really need, like, for a sustained situation to really be like topped, right? Or building a top, to see like volatility begin to base and turn. And it just got clubbed like a baby seal yesterday, like what, 15% or something like that. UVXY was down 10%. You just get destroyed. And so with the absence of volatility on a consistent basis or a persistent basis, then this is just like, it looked like kind of like rotation-ish. I looked at it, was funny because I looked at everything around, like say 130, like 130. And it just, it wasn't everything. It was just certain things that were turning. And then it looked like kind of rotational. And then, everything started selling off towards the back half of the day. But, we're so far from any type of real damage to any of these charts that I'm still very kind of sit and wait and watch. Vol had a good move today, but
it's not going to do anything. But we also talked about this last week. The gap fill is 1861 on VIX.
Yeah.
I'm not at all happy with high probability shorts, other than like it was very clear the small caps were rotating, lower with oil and gas all getting hit. They could pop up just as easily, next week. But the point is, it was very clear this is chop, and VIX is not really going to stop, and reverse and head higher until it fills that gap. It's so close. It's so close. So I'm still holding out for that. And I showed that last week, but it is still $18.21. That's the prior low pre-COVID, before we had the drop down February 24th of 2020. So 18.21 is the gap fill, and I'm sticking with that. I think we just need to take that level out, base, and then form some kind of pattern for higher. In the meantime, dollar's moving higher.
Yeah, I think you see a little bit of shift, like structurally. You're starting to see this shake out, and we're getting towards the summer. And if it was going to blow off, then this is like kind of that, quarter began, and you get the inflows and so forth. I'd like to see the dollar, that you wonder how the dollar plays with this kind of thing that they put out. Because what I said last week, I was like, hey, what are they going to do? Keep like throwing in trillions? Like they're going to have to throw in trillions of dollars. And sure enough, this week, 3 trillion more, right? We're gonna do another. We're gonna do a whole infrastructure deal. And you see the reaction with the dollar, right? Reaction was, okay, we're gonna keep kind of migrating higher. So you got to kind of these things that got to shake out as a whole, right? And they're still not done. And you got the equities inflows. It was funny because you saw the NASDAQ, QQQ was sponsoring the NCAA tournament. I saw that yesterday. This weekend, right?
Oh, that's
and
right.
They're like the prime sponsor of the NCAA tournament, and you get the large inflows, right? And so it's really and there was a lot of fractals as related to what was the sponsor of the tournament in 2000, right? And that time frame too, and it was the same type of stuff, tech stuff. It was just super interesting. And so you've got these things that are shaking out. Then you've got the dollar, and then you've got volatility. And we've said that the dollar and volatility, like the last pieces here. And then if we tie it back to the Fed being trapped, Fed can't do anything. Fed can't raise. Fed can't. They are trapped. They're totally trapped. They don't have to do anything right here, realistically, except talk, which they do, every day, at least a couple times a day. And they're not going to do anything. But you got your yield curve, the steepener that is taken out, and that thing hasn't slowed down. And
no, it has not. And I still contend that is beyond strong, and folks don't give it enough credit. They're just like, oh, it can come back down, and yes, it can digest and grind and have sharp moves.
The dollar and that, right? The dollar and that are, right, like really kind of showing how potentially strong the repositioning of the really, really, really strong hands is starting to be like, I'm not participating. Yeah, I've seen like flows fall out on IWM and SPY that I have not seen in some time, like be on the negative side, right?
Let's talk about the dollar real quick. So one thing that I pulled in anticipation of today as well, because I go looking for this stuff. I want to know how, where we're at with major asset classes, and dollar as a safety trade, if you will. But it's also when I had a thesis, which was Japan was doing a currency hedge. While rates were rising very strongly since January 27th, which was the previous FOMC change of language to the inflation mandate, that they were going to let it go higher. No one talked it down. And then TNX, the 10-year, just kept going higher and higher and higher. Japan was hedging that currency by, it was going down there relative to the dollar. And now during that period of time, the dollar was stabilizing. And now for the first time, leveraged funds turn net buyers of the greenback for the first time since November. So this is now those shorts have covered and they're actually net long.
This is what you want to see, right?
Yeah. It's a basing pattern. This thing needs miles and miles of track to come to a stop and turn and go back and reverse. So this is what I wanted to show as it relates to the dollar. And then the dollar yen carry trade also stopped going up, and the yen has actually served as a kind of hedge. The dollar right now is a kind of hedge because every hedge that we looked at has been taken out, right?
Yeah.
So there hasn't really been, gold hasn't been a hedge, bonds weren't a hedge, VIX wasn't a hedge. Oil, was until it wasn't in the last week, and it's dropped 15%, but that's also part of speculation. When it gets too frothy, it comes down hard, just like the ARC, right? Dropped 37%. And all that illiquid stuff that they hold is just impossible to manage. So I look at this going, I don't think that with you, the tech trade is going to recover as quickly as folks think, although it is fascinating the ETF inflows that are coming in for the Qs, right? Then I see the dollar strengthening, the yen strengthening, and I look at the bonds going, yes, we definitely need an end of month bid, for the rebalancing for pension funds. And by the way, it's supposed to be the strongest one in a decade. So we should have some softness in equities. Where's the hedge? And honestly, first and foremost, where's the hedge now? Since we just talked about this last week, oil got, taken out and put aside.
Yeah, I mean,
on inflation, quote unquote, fears of Euro COVID lockdowns.
I think that the reality is that you've got such an experiment with interest rates for so long that any of the correlations are, you gotta set them aside, and then you've got to look at what's the kind of temperature of the week of the flow. And so what I mean by that is, like, if Kathy Wood is risk off and ARC is risk off, where's that rotation? And that's a temporary hedge, is the rotation away from the pain trade. And the pain trade is wherever the liquidity is coming out of. Like, and you'll see her take a stab at going hot with call buying probably next. Like, she's got to double up to, like, lever up to try and get back to where she was, which will blow them up even more than likely. So you look at, in my opinion, like, if volatility, until volatility becomes stable, right? You've got the bond market, which is historically, maybe I can hedge, right? You got gold, historically I can hedge. You're going to hedge with, like, Bitcoin, right? Like, that's running its own direction. You have these pockets of liquidity where, to me, and this is just my opinion, it's almost like if you're trying to, like, kind of hedge, not necessarily delta, but just hedge, maybe macro kind of, risk off quick pivots in areas, then you're almost looking for kind of the weakest play at the table that's going to get hit, right? And, necessarily short it, or, kind of do a pairs trade or synthetic on something like that. And you're short that and long something that, is rotating from. Because I saw it, like, and it was like today, you saw the Dow was not as licked as the Russell. I mean, that, which one's the worst of the two, right? Russell was crushed. It was like 4% at some point intraday. And then you've got the Dow, which was holding pretty steady at, 50 basis points for most of the day till the last few minutes, and the Qs, right? So the trade has been long Facebook, short Netflix, Facebook was, long those things, and short the other side, right? And banks have been down about 6%. So it's almost like where you would have found some safety, right? And maybe a more temporal trade, like, intermediate trade, you can't do that because it's so distorted, because the liquidity is so, kind of abundant to an extent that things are pocket running, right? And that's why I really have been doing the options thing to try and create something that's much more dynamic. Because if you can see that too, it should help front run to an extent where you can look at where these pockets will go. And because volatility in and of itself is a target of speculation. And so you saw just massive puts on those ETNs yesterday. They were just getting obliterated. And then today, those got washed out same day, I suspect closed. I didn't look at it like extensively last night. And then back on the long side today. And like that, I mean, so are we in a trader's market, intraday, couple day, that's hedging based on just simply like very short to intermediate term plays based on liquidity versus historical correlations. And that's why I think that stuff like the yield curve screaming, there are problems under the surface here. Forget the price action and these rotations from what's cheap to what's not cheap, right? There's some structural problems. The dollar's holding on to that. And until things start to get, and what I was going to show, I think, I'm just trying to remember back exactly when we first got on the call, I thought about something right before we got on the call, effectively, that once this takes place, once you start to see risk come into the environment, when there's such an excess of positioning, then you will see major distorted moves. You have to have stuff like you've created, where some of this more like kind of the deep, fancy kind of models are going to be hit real quick and obliterated, right? They won't work, and a lot of the correlations won't work, and you're going to need really trustable, that's a word, I guess I just made it up, very trusted type simplistic structures that give you really tried and true kind of move, right? And I think that's
the noise.
It's because it is so distorted across all asset classes. I saw a thing with Wealthfront, I think it was yesterday. It's their ad, and it's like, you should just always be long and investing, just let us rebalance, and it always just things go up. Effectively, is what the ad was like saying. And I was just sitting there thinking to myself, it's like that is totally a fair statement, as long as there's no volatility. When there's volatility, the displacement of all those algorithmic models will be fast, furious, and merciless, and it will be, over. Like, March was a blip to what we've continued to create since then, March last year. So I think that like my take on hedging or like basically like where you would rotate, right? You've been really spot on the rotations from a standpoint of like, this is, as long, and we've said this, as long as there's volatility is muted, it's what's cheap, right? And what's not, and what's going to be in the trend. And this,
I like them smoother. Another
not gonna happen now. I think that you're looking at, I think I'm not going to discount that you could see that blow off by any stretch of imagination, because there's such an animal spirits mania across all.
No, it's not animal spirits. It's spirits. It's U.S. stimulus comprises 25% of GDP.
Oh, 150%. All this is it's fiscal.
No animal
plus
spirits. It's just pure visceral.
Well, you got animal spirits when people are buying pictures of tweets, right? Like NFTs. Like I mean, this is like
NFT Bitcoin SPAC. Sold up 225% on a day trade.
Saw a marijuana. You could buy a picture of a jar of marijuana. That was my favorite one so far.
No, it's painful. It's painful because some of us are still looking at this going, okay, we know we're divorced from reality, but I love, okay, old tech is catching a bit over new tech, Cisco, Intel. This won't last. But I'm looking for any little bits of rotation to hold on to, and it's not durable.
This is the last 2 weeks have been like
fragility of top.
really in the same like band, right? And that's why I say I wouldn't want to come in and be bearish like coming into today or what have you. You got these Fed speakers all week, and these guys, they're not going to say anything to upset this, because their number one enemy is volatility. and I said this in a tweet, and I said this last week, with all these passive models that all the money is in, for the most part, volatility doesn't jive with those models. They don't rebound. They can't handle volatility. And you've seen what happens when it comes in. And so they will talk and speak to anything that keeps volatility down, right? Like it's not anything else. It's not like they're worried about inflation. They're not worried about deflation. They're worried about volatility.
But we have to talk about inflation now, right? So the whole thesis is rock and a hard place. And this.
All right, well, yeah, let's go for that.
Yeah, because this is definitely
deflation for 200, Alex.
We can have both. But I still keep going. I started this, at the very beginning going, okay, inflation expectations are going higher and they're going to continue to go higher. The market, the equities market likes it to a point. Right now, everyone is like, okay, we're okay up to 2% in the 10-year. We're not there yet, right? We hit the 1.7 something and then, bounced about 9 basis points lower. Big deal. Big picture, we're heading higher. As long as this tracks, break evens, I don't care if it's a 5, a 10, what have you. The market has been, for the most part, rolling along with this, this theme. But at the same time, I'm also tired of the whipsaws because we're getting to a point where it has extended so fast and furiously, right? That rate of change that we've talked about in the 10-year, the 5-year, and it's still not done. And then recently, the short duration, the funding markets went negative 1 or 2 days last week, and that created some of this ripple effect. And then the SLR wasn't extended, which, big banks said, we have no problem, we're fine. It's the smaller banks that are, potentially at risk. But the whole segment, if you will, when yields softened and oil, was the tell, and the reopening trades are now 5 to 10% lower. They still haven't broken their trends, by the way, but they're still in this whipsaw kind of mood. We're going to go right back up to inflation expectations soon, as far as this trend. But in the meantime, it's this wide fragility of chop that makes it, I can't imagine if I'm seasoned at this, like this is my jam, is sector rotation. How are these young traders who have come in and buying up massive amount of SPACs, massive amount of ARC holdings, the illiquid as well as the ETF, what kind of losses are they sitting on? Or are they all made up by the GameStop wins that they cashed in on?
I don't know. I gotta believe that the what happens, like it's casino, right? The longer you sit at the table, less likely you are to walk away, in a stronger position than you sat down, because it's the law of averages. You keep playing those kind of intra-week hands, like where they have been playing on a nonstop upwards kind of trajectory, from November on, really, and that's been kind of tested. So now we're talking about where you actually are not seeing these names like that. You saw some of these Momo names, they're not bouncing, like the flows are gone from them. Flows are really negative. They're not coming back. It was bouncing, it's not bouncing. I'm going to trade it again, it's not bouncing. I'm going to trade it again, it's not bouncing. This is what we were talking about for a while about bad habits. And what happens is the habits get created on, after a 21-day period, just like anything else, where we see these things happen the same way over and over and over again. You start to see some of that stuff slow down a little bit. And that's why I was very interested to see if there would be some sort of stimmy jump right last week when these things hit the bank account. It's not that case. So now I think we're at the kind of the final playbook here, where that's not as big an impact. What are those guys doing with those types of trading accounts? Couldn't tell you. I mean, I've seen a lot of people, it was interesting to me because I was like seeing a bunch of and now that you say that, it makes me even really think about it. I saw a bunch of hold on to your losses. This will turn around. And I look up at the Dow and I'm like, we're down like 25 basis points. What are people talking about? And it's what are you in? So you're in these kind of they were moving 25% in a day. And I looked at the Momo list today and there wasn't hardly anything green on that list again. And so if you're not diversified and you don't know the different plays, and then not necessarily diversified across a portfolio, but diversified in your tool set of what you're going to go attack with in a trading environment, then it's going to become very much more challenging going forward, especially in chop environment where levels are not, I've seen the futures traders do really well right now. There's a couple of them that I follow that are really, really chopping it up because they can demark levels. So, bullish above, bearish below. But
I
as
wasn't
far as
necessarily talking about technique. I was talking about the young traders that came in 1 year ago.
Well, what do you know if to their defense, right? Like, they need some tools, and then they need to see this stuff happen once. We're sitting here, I've traded, I don't know, 12, 15 years, something like that.
We understand how this, the whole bond portfolio, risk parity is tied to tech. And it's under pressure, and inflation expectations are really, the stock market is looking at earnings expectations, as it relates to, they have become inflation expectations. So that's where we kind of go to the Fed and go, what are they going to do? They say that they want more inflation, and they're never going to admit what we really have as core.
Right.
But this whole anticipation of the market pricing the rate increases for the Fed, we've done this before, up and down. And with the exception of the past week, the gyrations we've had, obviously with softening yields and such, do you think that this inflation expectation that's been tracking so well since the bottom, right, this with the indices, is over? Do you think the duration trade is over? Or do you think this is just a pause that refreshes post-Fed, now that we have them out of the way and they have basically talked out both sides? We want inflation, but we're not going to raise rates. We're worried.
I think that the path of least resistance is inflation and UBI, because deflation ushers in volatility, and volatility will destroy the pension system. And I think that's the best I could answer that question, because they just don't want that. Like, and if you look at the way that they have approached everything since last year, and you're sitting there and you go, all right, so what did this entity do? What did these people do when faced with this dilemma? So I'm sitting there and I look at the dilemma, and I got pension, evaporation, and then these unfunded liabilities in municipalities, where the things are just going to stop working, right, so to speak, and volatility will erase these passive funds in, like, they say it was the fastest drawdown ever last March, like the fastest bear market of all time. Well, it's because of the construct of the volatility infrastructure as it relates to the passive ETFs and everything else. So yeah, this thing's all going to be fast. When it happens, it's just fast, 5% in a day. And then we're range trading 7% plus or minus in a day, right? Like, and that's what we did in 18. So we did in early 18, late 18, and then in 2020, just growing in scale. So that's the enemy. So they sit there and they look at that. They're like, lumber, screw it, right? Just press the button, like, both levers down. We'll send everybody checks. If inflation is ridiculous, they screw it. It's the wealth effect. And that's their harbinger, and they use it all the time. It's like the rising tide lifts all ships. What's the problem? 401ks are up. What's the problem? Housing prices are up. Go refi your house. I genuinely think that's the way they approach this. It's like, it's fine as long as things go up. We don't care. Well, and if you're on the back end of that, then we'll just throw you some checks. And I think that, like, that's their perspective on this. And that is, like, it sounds like I'm kind of shooting from like 50,000 feet, but realistically, they don't say much different than that on a tactical basis. And, we're seeing, like, the bonds get torched because effectively that particular approach at some point makes you, totally bust. And you cannot continue to think that you can do that into perpetuity. And so I think that maybe, our paper is being, and I haven't looked at whether or not the foreigners have continued to, or where their positioning has been and continue to purchase, treasuries in the last, 60 days as this has, really cratered. But that's something that I think is got to be monitored going forward.
They were net buyers in January, but I think they did a lot of currency hedging because obviously we sold down a good amount since that. But yeah, I'm still fascinated by your comment that deflation obviously is volatility, and that's something they can't afford. So they're going to keep talking inflation up, no question. And we still have, PE differentials on forward earnings are very, very supportive of this continued theme as well. I'm not seeing anything that the Fed is saying to knock this down. I'm not, right now growth is, it's still, forward PE differentials are benefiting that whole growth to value theme. I've got my own intermarket tells that have said we're not done with this theme yet. Bonds are not done selling off yet. I just posted this, update every month, which is the 30-year Treasury bond price, long channel since the 80s, right? And this is my kind of indicator of when it is a good short, when it's a good long. We're still in sell-off mode, right? Since August, September, we just picked up.
I could see that breaking down and really break it down and then coming back up to test that underside of that channel, and then that's over.
And this is just a 30-year. You know what has happened in the 5-year? It's hot fire flames. So this to me is just not done. Like you said, the Fed is kind of in a tough place. They definitely want to keep talking up inflation because deflation is volatility.
Well, think about it in the context of like, hey, I'm kind of in a tough spot from a budgetary standpoint. And so I got to grow my way out of my position because I cannot monetize my way out of my position. And what I mean by that is I cannot liquidate it. Like I cannot take care of my debt. I have to grow my, revenue and grow my margin so that I can then service and then liquidate my debt and erase it. And we're at a place now where that's what, kind of the crux of the conversation is relates to Fed trapped. They're really trapped because, we've gone past the point of no return in the last 12 months where this can be put back together. And now it's kind of, what's the least painful solution to the situation we find ourselves in at the moment. And that is letting inflation run extremely hot until it burns the house down. Because they cannot, and that will directly correlate to the bond market, in my opinion, not being able to recover, and that's the end of that secular bull.
We can talk about all the bear cases we want, right?
Yeah.
But there's one really big bull case, and that was Powell himself writing in the Wall Street Journal op-ed, as long as it takes.
Oh, that's the growth. That's my point. That's the growth. How long you going to keep this up? As long as it takes to grow the overall pie of GDP or whatever, we want full employment. We want GDP to max out. We want, and it's effectively the Chinese kind of playbook to an extent, right? Where,
his term expires in February of next year. And this is right now very political. I know Yellen's still, and together they're two peas in a pod. But
who's next? I think what did they say? I think it's I've heard Bostic.
Brand,
Atlanta.
Brainerd,
yeah.
Yeah.
But you're gonna get more of the same. Like they're not gonna put somebody in there who's gonna be like Volcker. It's not coming, right? No chance. Yeah, we're gonna fix the inflation.
But that's so Draghi-like, right? Whatever it takes, as long as it takes. I mean, they even echo the same. Anyway.
It is until there's something that triggers that they did not account for or could not account for in the modeling that then causes the spike in the environment, right? Which then deflation.
I still have mine, which is not this month. And I said that, forget March, because we popped above in that 65, right? We went to 68 in crude. And I said, okay, we break 65, we're going to hit 60 down to 50. But as long as we close above 60 on the monthly, we still have the potential to head higher in April and May, which drives up CPI, all that inflation expectation, that whole pivot to oil, if you will, in the summer months that can drive it to 75, 80 bucks. That's something the Fed isn't necessarily controlling. Right now, there's very weak speculation to support, in other words, speculative interest to support that. But the month's not over yet. So I'm still looking for April and May for some much higher prints in CPI and much higher gasoline that would drive that into a potential very strong spike. It's early innings. I only had the idea when we talked, right? Like 2 weeks ago, and I said early innings, let's get through March 1st, especially with the rebalancing in the pension funds. And then let's see what it really does in May for the April CPI, June for the May CPI. But I can see oil getting away, if you will, and really triggering that inflation shock.
150%.
Only on speculation, just on speculation alone and inflation expectations driving it, which is something the Fed does not easily control. So for right now, it's not a thing, but that's
I
here.
fully agree with that. And you've already got the supply, and I think there's a good argument to be made for supply chain, like, causing some of the inflation problems to an extent that there's just supply chain problems based on what we've experienced in the last year, and maybe that sorts itself through by the latter part of the summer. I can kind of get on that bus a little bit to an extent.
Because people are going to spend it on the stock market, their stimulus check, or on consumer demand, pent up travel and dinners and all that.
Yeah, which go back to it's heading back out, into the real world, and that's real money. That's not lent money. That's not money going to the bank that is then lent out. That maybe goes into a paycheck, maybe goes into capex. That's money that goes into people's pockets that they go spend, right? And so that's hot money, and that's inflationary.
So that's where I'm kind of biding my time to see what happens with CPI and oil in April and May.
Yeah, what's wild is the crypto. And I was thinking about this, and I was curious your thoughts, and I'm curious people's thoughts on this. Is the money that would have gone into, because we're here we are. We've printed trillions and trillions of dollars. Mm-hmm. And we did fiscal and monetary, and the gold conversation for years was when this happens, and it's happened. And did that money flow go into crypto instead of into gold, instead of into silver? And do gold and silver still come out of this with the kind of final straw? And I know what like Jim Rickards would say, right? But my curiosity in the sense that there is a lot of money flowing into those trades, the crypto trades, would that have gone into the gold trades? And would we be talking about a much higher gold price? Right.
And the same thing about bonds. It's not going into bonds as much, it's going into crypto. Institutions are just starting to step up and have a position. I'm definitely not on the crypto Real Vision channel 24/7, but I would say
yeah, I get it. Yeah.
But I would say that it's very it's still US dollar based, still very much a speculation that creates the narrative. I just love, in fact, all these narratives, and in time, there has to be something substantive behind it. The NFTs, the cryptos, I know not the blockchain, but we have to always crouch that whole conversation, because there are silver bulls, there are gold bulls, there are silver bulls, and there are crypto bulls. I don't want to get in front of that charge, but I really don't know if this is the one big test that we're going to have when this does have a pullback of any size, how damaging it is this time, because the psyche, I don't know, this whole trade to me feels incredibly cult-like they're just not going to let go, because they totally are banking on the US dollar to collapse. Why would you wish that on anybody?
Yeah, well, I think it's a margin thing too, as it relates to the way people are. You've seen the margin debt charts, right? We're now way up there to, max levels of historical proportion with margin, right? And if things don't go down and you got the Fed put, and the perspective of the Fed put, then you max long, right? Max long on margin. And I think that that structure in and of itself, if you go over into crypto, then you have margin on margin of margin, right? So you can do 10x, 20x in some things, right? Like, and so I think that, that is kind of, if I took a step back and I looked at it and, what breaks these things down when this does occur, to have a deflationary impulse and a volatility spike that causes liquidation, those are all correlated. They're all relatively the same thing, because volatility is just an indexed measurement of the liquidation or lack of liquidity in the environment, plus the lack of both sides of the trade. So effectively, you get a vortex where everybody's net long on margin, and then you go into crypto space and they're on margin of margin of margin. I think it's the biggest threat to that space. And then the biggest threat to the market when it happens is that people will become net sellers because they're forced liquidators. And so I think that'd be my 2 cents on what could turn it over once it's said and done, is that it just is simply the weight of itself, because you've got tiered up, levered up.
You've said that before. The supply is actually, it comes under the weight of its own supply, which has worked so far with ARK. It's worked so far with SPACs. And not that they can't, rally into a new NASDAQ, type of blow off top. But what I see is just asset inflation versus real inflation. What I see in the economy is real inflation percolating up. So oil aside, because we still have to have the demand component, serious demand component drive this, as well as supply disruption, or in the case of lumber, supply inelasticity. You can't just throw a tree overnight. So I just really think that some of this, the crypto, I would like to see it be tested, a come to Jesus kind of moment, where they actually say, okay, the dollar's not going to debase enough to justify my holding Bitcoin down 50%. It definitely is asset inflation right now, that whole camp. And cult-like, we're not going to let go networking effects. At some point, I would just like to see it tested to see the resolve. This is
there's been
the last hedge, I guess, to discuss, because otherwise nothing else is moving as it passionately, right, as the Bitcoin and crypto game. So
well, I mean, that stuff is its own market, right? And it's regulated differently too, right? Because that's how you get 10, 20 times leverage, right? You're not going to get that in like a FINRA, type situation, or SEC type structure, SPIC insured type accounts. So these are all wildly speculative, and that's just kind of the environment that we're in at the moment with the fiscal and the monetary. So, you consider fiscal and monetary, keep going. It's that trap that is what is it, and I don't have an answer of what it is that would trigger kind of the Fed, where they're stuck, and then they have to do something, and then they have to pick a person at the table that's going to take the shot. Is it the pensioners, or is it the Zoomers? And we don't know that answer, that playbook yet. We won't know, maybe a few more months, because it's running high. I think that, and most of the it's very tough. It's kind of feel kind of bad sometimes, like looking at some of the stuff. So somebody said something that they spent 15 years working on the gold trade, and it comes time, and the dynamic shifted underneath the market of exactly how the flows of funds weren't, and you're sitting there kind of like 15 years. Some of these guys feel for it to an extent of all the research, then the time that they spend in these trades. But it should be interesting to see, because gold and silver, I still have those targets on at lower levels. And what is it when it comes time that I think it almost seems like you would be questioning to an extent, like when baseball cards are trading for $70,000, right? That was $17 2 years ago, right? Dumb shit like that, that I'm seeing, and you're sitting there and you're like, well, what is money? And so it could be where this is all headed to an extent, is what is value, right? And once everything is valueless, then what is the value of anything?
What I love is also this anecdotal data point that I saw today in regards to since March of last year, right? The housing market has not only recovered, but
Oh gosh, yeah,
yeah, right.
flaming,
So
yeah.
it's flaming, it's manic. But the most interesting data point I saw was that right now, nationwide, there are more real estate agents
Oh
than there
gosh, I
are
saw that too.
houses available.
Yeah,
And I thought to myself, that's it. You know, like that's also the Bitcoin trade.
yeah, yeah. Well, it goes back to in the movie, what Money Never Sleeps, that Douglas did the revisit of it after 2009, and the mom was a nurse, and she was flipping houses, and he's like, what was wrong with being a nurse? And if I've had one conversation in the last 18 months, or let's say the last 12 months, I've had 50 that I was doing this. Now I'm like, a total speculator on baseball cards or NFTs, or I'm selling weed, pictures of weed online. I mean, it's like the that type of speculative transition from goods and
Gamification.
services, the goods and services of a natural economy, to where everybody is speculating, I've read a bunch of the historical analogs to that. You're talking about like the 20s, and you're talking about South
Oh, that's
Sea
true.
bubble, where everyone became a speculator in some context, and you don't know when those things end, because they can go way past what you think.
Oh no,
And
they end quickly because the fickleness of the crowd that
well,
joins
no,
first, the last in or the first out.
it's the speculative nature of it where it then becomes a margin. So when you look at like a great book, Devil Take the Hindmost, from Edward Chancellor, I think, is a great study of that, right? Of the manias, panics, and crashes was another one. I want to say that was Chancellor, but both of those books, I'd say both those are really good in the context of these types of speculative environments have happened prior, and they all have the same kind of construct, which typically is an interest rate prolonged period of time. And that's what especially got the South Sea bubble going,
Well,
is
this
the
is
prolonged period of interest rate
so
manipulation.
this is my whole thesis that I'm still stuck on, obviously, for months now, And even though we've had some drama, if you will, since the Fed in the reflation reopening trades, and inflation expectations definitely need to come, and the oil trade need to have some of the froth come out, just like the tech trade, right? So there's this healthy, if you will, pullback that's very sharp, that rebounds very quickly, and then there are the unhealthy pullbacks that just never really get back up
Yep.
into it, in
They lose their levels. Yep.
right.
And
So
they're gone. They never get them back.
it's wonderful, but for me, the whole construct is this old regime that you were just talking about, the interest rate regime, right? The macro regime has been so married to that 60-40 portfolio, so married to lower rates for longer.
Yep.
Despite what Powell is saying, as
Yep.
long as it takes, it seems very clear that the rate of change in the yield spike that has been going on for many, for months now, and the steepening of this yield curve, to me, just means it's going to be dramatic. Right now, we're showing this aura of volatility up and down, but I think this kind of shows a little bit of that um, duration trade that I kind of warned about, that you and we track all the time. But this 10-year yield, as it relates to the strength of this having power over the tech correlation, is not going away. And if anything, it's even tighter, it's even stronger, right? This is an outlier that is showing 1.6 percentile. And that means that when there's this increase in yields, for example, the tech sell-off correlates 88%. I've seen figures of. That's really strong. So this, to me, is going to create disruption. That's my whole basis of the Fed might say as long as it takes, but at the same time, the market's already pricing in this tight correlation between any yield spike and tech damage. And it's definitely taken some froth out. We might have a little rotation into Facebook and Netflix and Microsoft the past few days, because that's the safety trade. and,
Yeah.
and in staples. But
Yep.
basically stuff that had been very, very strong, like energy, right? Up 20, I think 26%. And staples were, the opposite side of the spectrum with tech. And now they're just kind of having a nice little reversion, sector rotation, but they're short lived. So I still think the shift is in the regime change of the rates environment. And this is not going to go away. And in fact, it's an inflation signal. And we still have those inflation expectations tracking very, very tightly as a nice fractal. So now for me, the thing to watch out is what's going to be the trigger with all the cues, call buying and all the rotation of money that's come into the NASDAQ, right? The stuff that I just showed at the very open of the hour and also on Twitter. Is this going to foretell much higher levels, like a blow off top in 2000, right? That fractal that I started off with. Or are we going to have the opposite come to be, where we have liquidity woes and there is still strength in yields, and tech starts to get the message and starts to get worried and starts to sell off even more. So for right now, what's your bet? How do you think we're going to do in the next few months? Blow off top, grind sideways, correct in time, not price, or actually have some volatility that brings down all of the market, not just one at a time, but like nothing safe?
It's a common trade, so I think it's binary, right? Like, so, you've had rotational safety for a period of time. In the absence of volatility, we will rotate, right? So that's, pretty commonplace.
Which will rotate. Yep.
Yeah, right. And so if you have volatility, right, you're going to see everything get torched just because of the binary structure of passive indexation. So, where are we at with the reality of the market structure? And I would have to say, it really all depends on levels, especially with money coming in, because there's plenty of liquidity to be put into. It just depends on if that's spooked and turns into sell side versus buy side. Because if you're still pretty close to these levels, that make me kind of like, I'm short in here. And my buddy said that nobody's still very eager to short. And so you're sitting there and you have a lack of sellers, an excess of liquidity, and you're sitting in close proximity to levels that could just throw the gas on the fire. Yields, bonds, gold, be damn it all, right? Like, we're just going to put this money to work in the passive environment. And so you're sitting so close in proximity to that kind of that gap and go almost market structure that I would be on the lookout for that more so than I would be on the lookout for a breakdown here. What you would need to see a breakdown here, which could happen at any given time, right? Because of how fragile, right, it is. But you need multiple days intraday selling on high volume that breaks all the levels, and then it comes back to test that, and it's just Mike Tyson punch out right in the face, and those levels are just not seen again, and it's just impulse selling. And that's what I look for, right? And yeah, it's impulsive selling, right? And it's, you see these just huge bars just coming because it wipes out everything that was coming up on the Gorp. And because that was all soft bid. And until you see that, especially, we saw some intraday selling today.
Yes.
But it's like one day. It's one day. You need probably at least 3 to 5 days of selling that then come back up pretty quickly in a reflexive move that then is hit in the face real hard with more selling that they were waiting on it to come back. Then it's over. Until you see that, you're sitting in such close proximity to expansion levels, 4,000 SPX, right? The Dow is there's no soft look in that. And I see a lot of drawings and stuff, and that we're, I don't know enough about some of that stuff, like where, we've expanded exactly the same height. We went down ×2, and things like that, and all that stuff. It seems to make sense geometrically, but, we're not dealing with that. We're dealing with flows and interest rates and a lot of other factors. So to me, those passive factors sitting right there at these major index levels in the absence of volatility, which we really don't have right now, and I don't see on the curve at all. Even I don't see it rising on the curve. I haven't got a volatility signal in month, two, something like that. You know, I don't even remember. I have to go pull it in the system where I'd see when and to give you guys an idea, like my volatility formulas, you gotta have repeat days. You gotta have 2-3 days of consistent rising volatility of X a percentage day over day, and in potentially with the rising index, so that you can see some sort of underlying, and what that would entail is the underlying positional shift in the put call ratios of the actual players, and then a flow into those ETNs where everybody proxies, or the VX futures, right? And or both, right? And I just don't see any of that right now. So I mean, bonds be damned, dollar who cares, right? You know, rotation, whatever, these levels being so close to being expansionary, that with the absence of volatility, I got to give the benefit of the doubt to, you know, Jay Powell and the fantastic bunch, that they're gonna, you know, press the pedal down and keep the funds. It's not the speculative retail stuff that's going to push these things, and that's not what pushes it. Those things push the individual stocks around. Those things don't push. They don't push the Qs, right? The people aren't pushing the Qs around. The Qs are getting pushed around by institutional level order flow, and those major puts you see between calls between 4 and 4:15 every day. So like, I mean,
can't wait for earnings.
I got to give them the benefit of the doubt that it heads higher, unless you see an impulsive breakdown over a consistent period of days, which the way your stuff is developed, that you know have given us those formulations for. You're not going to miss that, right? It's clear as day. Those things are going to be going off like this. Maybe people won't believe it, but if those things go off, and that's what I was going to say, probably like last thing I wanted to say about it is, like, these tools that have been created will perform extremely well in periods of displacement, and they will print money. And that's really the way it goes in today's environment, is like when things displace, you're talking about massive monetary gains in very, very short windows of time, where everybody else is getting nuked. And that's the benefit of this stuff, is not only do you avoid the drawdown, you can be very opportunistic, because once this stuff does kick in, you know, it's going to be fruitful. And I can honestly say that's all I care about. Like, I mean, this upside is like, you know, you could set it and forget it to an extent, but the fruit for real trading and real aggressive players is like when they lose control of it again. With that, man, that's going to be like, you know, make 2 or 3 years in like a few days.
Well, for now, we're trying to figure out the next 2 to 3 weeks, I think, post the quarter end with the rebalancing. Any opinions since it's a little after 5 now, any opinions going into April of when this trigger for higher would kind of crystallize? Because I have the same suspicions, and yet at the same time, we're right approaching earnings, right? So earnings have been a disappointment, not in beating, but in regards to guidance, and they've been clobbered afterwards, especially in tech land. So, you know, we're going to be testing this, and price increases across the board and chip shortages across the board. It's going to take a few months for that to really work itself out. So I can't help but think we're going to have more of this fragility of chop the next few months, which is painful, which is why the indicators, you're right, are just a lot cleaner. There's less noise.
Yeah,
you have to think about what is the Fed thinking? No, we just have to say, okay, it just triggered, you know, neutral. There's no trade. Oh, it triggered bullish. There's a triggered bearish, the trade. But otherwise, I am just looking at this going, okay, this is going to be a long, bloody sprint.
I would say monitor your portfolio hedger formulation as like a key indicator of the overall construct.
Okay.
Yeah, be honest with you.
I use it inside out, like the risk range always goes first.
Yeah, 1 through 3. But like if you look at the portfolio hedger from this bigger conversation, if that doesn't trigger, it's all just noise.
Yes.
If that triggers and sticks, then you've got that impulsive environment that will, you know, come unravel pretty quick. So you don't have to guess and be, you know, it takes a lot of that kind of out of it to an extent where, you know, is this kind of Fed move or this speech or that, you know, give them the benefit of the doubt, they want inflation. So in the absence of volatility, you know, expect higher, you know, everything, right? And not necessarily everything, because the stuff that was a Momo chase around, maybe that doesn't go higher. But, you know, in a broad base index, you're going to see passive flows go in, and the things will just continue to head higher. So if that being the one that's really gauged around primarily volatility is really, to me, one of the better ways to look at it. And that will really help kind of clear out the noise of the overall picture. And then when you look at the short-term stuff, right, on the day in, day out basis, those 30-minute windows are really, oh, it's dinner time.
It is totally dinner time. Okay, you got a question in chat and then we'll close it. Yes, Stella, it is 5. I'm so sorry.
I got it, Stella. I'm done.
Oh my gosh.
I'll cut it out.
Like a clock. No, and I'm just dying to get outside too. We've had like no sun. I feel like, okay, so that was it. CTA, persistent night action, is still like selling the dollar. And I don't know, this is the night action is like 2%. They're still
no, typically what we see on the night action, this is a really good question. So when you see a change in shift, like, you know, those FVGs I have in the charts, fair value gaps that measure the gap from one night to the next morning in the ETF or the stock market, a single stock, individual stock environment, because the futures create the displacement that reduces and eliminates the auction bid. Those auction bid has to come back and be settled. So typically when you see, you know, we saw some displacement in March last year where the overnight was dropping heavily, and then the daytime would, you know, not gap. But there's only a couple. Most of the time when you see this really take place, that's why I say intraday. It's intraday action on heavy volume, especially in the futures market, that demarks the breakdown, where it breaks levels that the auction is fully clean. And I don't know that the overnight stuff, when you see the overnight breaks, if I said it once, I said it 1,000 times, and it's very hard to like really bang it into your brain. Like, I've struggled with that for years. It's like you see a gap, 2%, 1.5% overnight, and by the middle of the next day, it's you know, kind of recouped it and gotten it back to that auction even marker in the regular trading hour session. I like to, so my long story short, I like to see the daytime session break it, not the nighttime session. The nighttime session is, if it's on the upside, that's creating that gap and go garbage where you see all these gaps just left behind. You are right, we're not seeing that, but we're also kind of being level right now, and we're not seeing any type of sell-off. So, but you did see today, you know, sell-off in RTH. So I like and only really support regular trading hours dumps. I don't really like the overnight action because it's such a mess as it relates to the missing order flow from the day period, that during RTH, it's just such a massive difference in order flow.
Good question, Peter. All right, so this is how I entertain my cat.
It's amazing.
All right, I'm going to wish you a wonderful evening.
That is amazing. It's the best thing I've seen all day. Yeah. She'll start to attack it shortly. She'll start scratching it and the whole thing, but it gets her distracted from, you know, mealtime. All right,
it's great. Guys out there, spring is here. I wish everyone a great night. I'll post it on YouTube after dinner. Have a great one.
Thanks everybody. All right, bye.
Bye.